Investing is like a jungle gym. Exciting, but with potential for bumps and bruises. Just like kids on a playground, investors need to be aware of their surroundings and understand the challenges they might face. It's not just about the thrill of the climb, but also about being prepared for the unexpected twists and turns. Before you climb, you gotta know the risks. Just as a parent would guide their child on how to safely navigate the jungle gym, you need to educate yourself about the potential pitfalls in investing. This means understanding the market, knowing the companies you're investing in, and being aware of economic factors that could impact your investments. Risk means how much you could lose. It's the possibility of your investments not performing as expected. Just like a child might hesitate before taking a big step on the jungle gym, you need to assess how much risk you're willing to take. Are you prepared for the possibility of a fall, or do you prefer to play it safe? Higher risk could mean bigger rewards, but also bigger losses. Think of it as climbing to the highest point of the jungle gym. The view from the top is amazing, but the fall can be hard. High-risk investments like stocks have the potential for significant returns, but they also come with the chance of substantial losses. Lower risk is calmer, but might not grow your money as fast. It's like staying on the lower levels of the jungle gym or playing on the swings. It's safer and more predictable, but the excitement and potential for growth are limited. Low-risk investments, such as bonds or savings accounts, offer stability but usually provide lower returns. Understanding this is key to smart investing. Just as kids discuss and plan their moves on the playground, you need to strategize your investment decisions. Knowing the balance between risk and reward helps you make informed choices that align with your financial goals. Knowing your risk tolerance is like choosing the right size jungle gym. It's about finding the right fit for your comfort level and financial situation. Are you ready to take on the big challenges? Or do you prefer a more measured approach? Your risk tolerance will guide your investment strategy. Too big, you get scared. Too small, you're bored. If you take on too much risk, you might find yourself anxious and stressed. On the other hand, if you play it too safe, you might miss out on opportunities for growth. It's about finding that sweet spot where you're comfortable and can enjoy the journey. It's about finding what you're comfortable with. Just like kids find their favorite spots on the playground, you need to find investments that match your risk tolerance and financial goals. This ensures that you can stay invested for the long term without unnecessary stress. Are you a daredevil or a cautious climber? Your personality and financial situation will influence your investment choices. Some people thrive on the excitement of high-risk investments, while others prefer the stability of low-risk options. Understanding your own tendencies helps you make better decisions. This impacts what you invest in. Your risk tolerance and investment strategy will determine the types of assets you include in your portfolio. Whether it's stocks, bonds, real estate, or other investment vehicles, knowing yourself is the first step to building a successful investment plan. High-risk investments are like rocket ships, potential for huge growth, but also a chance to blow up. These are volatile, meaning their prices swing wildly. Think new, unproven companies, cutting-edge tech, or cryptocurrencies. Examples? Think electric car companies not yet profitable, or that new app everyone's talking about. Crypto, with its wild price swings, is another example. Remember, high risk, high reward potential, but no guarantees. The upside? If that rocket takes off, you could make serious money. Early investors in companies like Amazon or Apple saw huge returns. Same with those who got into Bitcoin early. Downside? Just as easily, that company might flop, the tech might become obsolete, or the crypto bubble could burst. You could lose a big chunk, or even all of your investment. High risk is not for the faint of heart. Low-risk investments are like tortoises, slow, steady, and reliable. They won't make you rich quick, but they offer stability and a lower chance of losing your principal. Think government bonds, certificates of deposit, or index funds tracking the overall market. Government bonds are like loaning money to the country. You get paid interest and usually your principal back. CDs are similar, but you loan to a bank. Index funds spread your money across many companies, reducing risk. Section 5. Playing it safe: benefits and drawbacks of low-risk investments. The good news? Low-risk investments offer peace of mind. They're less likely to lose value drastically, especially in the short term. This makes them good for preserving capital or money you'll need soon. However, slow and steady doesn't always win. Inflation, the rising cost of goods and services, can outpace returns on low-risk investments, meaning your money buys less over time. They might not be exciting, but they're essential. Section 6. The balancing act: finding your investment equilibrium. Smart investors don't just pick one or the other. They understand the importance of balancing their investment choices. It's not just about going all in on high-risk stocks or playing it safe with low-risk bonds. Instead, they create a diversified portfolio that includes a mix of both. This way, they can take advantage of the growth potential of high-risk investments while also having the stability of low-risk options to fall back on. They balance high-risk and low-risk investments to create a diversified portfolio. Diversification is a key strategy in managing investment risk. By spreading investments across different asset classes, investors can reduce the impact of any single investment's poor performance on their overall portfolio. This approach helps in achieving a more stable and consistent return over time. This helps manage risk while still aiming for growth. Just like hiking up a trail to reach a beautiful viewpoint, the journey of investing requires careful planning and balance. Planting seeds in a garden is another great analogy. You need to nurture your investments and give them time to grow. Patience and consistency are crucial in achieving long-term financial success. Think of it like a balanced diet for your money. Just as a healthy diet includes a variety of foods to provide all the necessary nutrients, a well-balanced investment portfolio includes a mix of assets to ensure financial health. This variety helps in mitigating risks and maximizing returns. The right balance depends on your risk tolerance, age, and financial goals. More on that later. Your personal circumstances play a significant role in determining the ideal mix of investments. Younger investors might lean towards higher risk options for growth, while those nearing retirement may prefer more stable, low-risk investments. It's all about finding what works best for you. But the key takeaway is diversification. Don't put all your eggs in one basket, especially a risky one. Diversification is essential in protecting your investments from market volatility. By spreading your investments across different assets, you can better weather the ups and downs of the market and achieve a more secure financial future. Section 7. Different folks, different strokes, age, goals, and your portfolio. Your ideal asset allocation, how much you put in different investments, changes throughout life. Younger investors, with more time to recover from losses, might take on more risk. Older investors, closer to retirement, might prioritize preserving capital. Saving for a house down payment in 5 years. Low risk is smarter. Retirement 30 years away? You can afford more risk. It's about aligning your investments with your goals and time frame. Section 8. Don't put all your eggs in one basket. The power of diversification. Diversification is key. It means spreading your money across different asset classes, stocks, bonds, real estate, etc. This protects you if one investment does poorly. Think of it like a safety net for your portfolio. Imagine putting all your money in one stock. If that company tanks, you lose everything. But with diversification, even if one investment struggles, others can cushion the blow. It's about managing risk effectively. Section 9. The bottom line. Invest smart, sleep well. Investing doesn't have to be scary. In fact, with the right knowledge and approach, it can be quite empowering. Imagine walking through a beautiful park, feeling confident and secure about your financial future. That's the peace of mind smart investing can bring. Understanding high-risk and low-risk investments is crucial for making informed decisions. High-risk investments like stocks can offer higher returns, but come with greater volatility. On the other hand, low-risk investments, such as bonds, provide more stability, but typically yield lower returns. Knowing the difference helps you balance your portfolio effectively. By balancing your portfolio, Diversifying across asset classes and aligning your investments with your goals and risk tolerance, you can grow your wealth over time while managing risk effectively. Diversification means spreading your investments across different types of assets such as stocks, bonds, and real estate to reduce risk. It's like not putting all your eggs in one basket. Remember, knowledge is power. The more you learn about investing, the more confident you'll become. Take the time to educate yourself on different investment strategies, read books, attend seminars, or even take online courses. The effort you put into learning will pay off in the long run. The more you understand about different investment options, the better equipped you'll be to make smart choices and achieve your financial goals. Happy investing. With the right approach, you can enjoy the journey and sleep well, knowing your future is secure. So start today, invest smart, and watch your wealth grow over time.